In September 2019, a real estate company filed paperwork to go public on the New York Stock Exchange. The company's name was WeWork. It had been valued at $47 billion by its lead investor SoftBank just months earlier. The IPO filing, a 450-page document known as an S-1, was intended to introduce WeWork to public market investors. It accomplished something different. It introduced them to the most chaotic, delusional, and spectacularly mismanaged corporate document in recent memory. Within 3 weeks, WeWork's anticipated valuation had collapsed from $47 billion to less than $10 billion. The IPO was pulled. The CEO was ousted. The company was in crisis. It would eventually file for bankruptcy in 2023. The story of WeWork is a masterclass in how charisma, narrative, and venture capital can combine to suspend the normal rules of financial reality for a while. Adam Neumann co-founded WeWork in 2010. The concept was elegant: take underutilized commercial real estate, redesign it with premium amenities and communal aesthetics, and rent it in flexible short-term increments to freelancers, startups, and eventually large corporations. It was called Space as a Service. The pitch was that WeWork was not a real estate company, it was a technology company, a community company, a consciousness company. Neumann was a mesmerizing salesman. He could convince investors that leasing office space and subletting it at a markup was somehow analogous to building software. The narrative worked spectacularly. SoftBank's Masayoshi Son famously met Neumann for 28 minutes in 2017 and committed $4.4 billion in investment. Son later said he had bet on Neumann's crazy, not on his financials. The financials, when finally disclosed in the S-1, were extraordinary in the worst possible sense. WeWork had reported $1.8 billion in revenue in 2018. It had also reported $1.9 billion in losses. It was spending more money than it made. The more it grew, the more it lost. Every new location it opened required a long-term lease commitment from WeWork, typically 10 to 15 years, while its members could leave on 30 days' notice. WeWork had locked in enormous fixed costs while maintaining almost no revenue certainty. It was, structurally, one of the most fragile business models in commercial real estate history. Wrapped in the language of a tech startup, it had been valued like one. The personal conduct disclosures in the S-1 were equally striking. Neumann had personally purchased several buildings and then leased those buildings back to WeWork, collecting rent from the very company he was running. He had trademarked the word "we" and then sold that trademark to WeWork for $5.9 million. His private jet usage was extensive and company-funded. The S-1 described WeWork's mission as elevating the world's consciousness, a phrase that investors looking at $2 billion in annual losses found difficult to reconcile. The document also revealed that Neumann had structured his voting shares to give him extraordinary control, even more than Mark Zuckerberg's grip on Meta. WeWork had been run, in essence, as Neumann's personal enterprise, funded by institutional capital. Neumann was ousted as CEO in September 2019 under pressure from SoftBank. His departure was negotiated on his terms. He received a package valued at approximately $1.7 billion, a golden parachute for running a company into the ground. The optics were catastrophic. WeWork employees who had taken stock options as part of their compensation watched those options become worthless while the man responsible for the company's implosion walked away with nearly $2 billion. SoftBank, which had invested $18.5 billion in WeWork across multiple rounds, eventually wrote down the vast majority of that investment. It was the most expensive 28-minute meeting in venture capital history. WeWork finally filed for Chapter 11 bankruptcy in November 2023. The company that had been valued at $47 billion 4 years earlier filed with less than $2 billion in assets. The WeWork story is not simply a story about one charismatic founder. It is a story about what happens when the venture capital ecosystem, and specifically one fund with $100 billion to deploy, prioritizes narrative over numbers. SoftBank needed to deploy capital. Neumann needed capital. The story was compelling enough that normal financial analysis was suspended. The markets that should have asked hard questions were too eager to participate in a story that felt like it was going somewhere extraordinary. The lesson: charisma is not a business model. A compelling vision does not offset structural economics. And $47 billion is just a number until someone actually has to pay it.